I think it's quite clear as we go through this series of events that the biggest focus right now is what the central banks are going to do next. Now, yes, we've got the ECB tomorrow, but we've got a very big week ahead for central banks next week as well. So this next 10 days, I think, could be crucial. I think it's going to increase volatility. I think trading is going to be a little uneven and difficult to do. But, once we get this ECB out of the way, the focus is definitely going to be on the Fed, the Bank of England, and the BOJ next week. These are all big meetings. There's an awful lot going on in their economies. There's been a lot of chat out there from the central banks recently. They're all moving into this blackout period. So we won't be getting any more heads up from the Fed because they're in their blackout period. Very unlikely to get much else from the Bank of England or the BOJ until these meetings. So nervousness into the meetings. They have all told us that they are data dependent. So any data that we get between now and then could have an impact on markets, any data really. And I have to say that forecasting anything or trying to take a medium-term position within all this at the moment is high risk because there's just too many moving parts to it. So this is not going to be easy, but it's going to be fascinating. And the data has been flooding in, and we may get strong data, weak data. It's very difficult to get a handle on what they're going to do. Now, the problem is, because we're slightly confused, I have to assume that they are too, because it isn't clear where the economies are at the moment, or where they're going. And the reason why they're not clear where they are at the moment is because interest rates that rises we've had already, these all act with a lagged impact into the economy between sort of average about 11 months, maybe 12, 13, 14 months. And so we don't know what the full impact of these rate hikes has been so far. Now, if we look at some of the economic data we're seeing, these rate hikes are beginning to have an impact in certain areas. So aggressive interest rate hikes from the Fed and BOE have made today, that they've made today, are slower to impact. So it's difficult to know as we move to the end of this hiking cycle exactly where the peak is going to be. Yes, we have peak inflation, but inflation, as seen today in the CPI data from the US, that inflation has not gone away. They have not beaten inflation. But how far do they think they can risk to go? And, if they go too far, they could kill the economy dead, and then they could be looking at deep recessions. So this is going to create volatility around this. Will they get this right? Are there policy mistakes potentially out there? Yes, there are. It's not easy to deal with what they're dealing with at the moment because there's so many moving parts to this. So caution into this next 10 days, but opportunity as well if you're clever. So the first one on Wednesday is the big one. We get the Fed, the FOMC meeting, interest rate decision at 7 o'clock our time. Again, I think the press conference is going to be more important. The market is pricing a skip to this meeting, so nothing expected on rates really. Market more or less priced that into, I think it's about 10 basis points priced or something like that. But this is the biggest event of the week because what Powell says in the press conference, I think is going to be formative. It's going to impact commodities, the dollar, just about all major asset classes, I would think. If we look at the dollar, the dollar's been very strong recently because of this US exceptionalism. The US data has been far stronger than anybody else's. And so, it makes sense that out of the G10 nations, the dollar's done better than most. And also, we've still got 5% 2-year yields in the US, which is very attractive. So, people are moving money back into those dollars to sort of get that yield, if you like. So if they skip, what happens to the dollar? Well, because the market is pricing a skip to this meeting, so i.e. no change, then I think the dollar does very little. But it depends what Powell says about what may be coming next and how concerned maybe he is about inflation. If he is still very concerned about inflation, the dollar could see another rally. So his assessment also of the potential for a soft landing. Now, remember, he has to play a bit of as a politician. So it's very unusual for a central banker to say, actually, we think a recession is coming. But I actually think a soft landing is hope as much as anything. But yeah, the data has been much better and more resilient than many people thought. Talking points, we have to ask ourselves, has inflation started to rise again? The CPI data today was in line, but it was stronger than the month before. Oil prices, energy prices, look at those. We are really starting to see these move higher now. And there seems to be some real supply issues coming up for oil going forward. So, a poll sees US inflation rising. The problem I have with very high diesel prices and oil prices as well is they do manifest themselves very quickly into inflation expectations from the consumer, which is not what the Fed wants to see. So could they hike? I mean, they could. It's not priced, but the talk is that they'll probably wait until November for that. So what are the implications for stocks? Well, if they do nothing and he is very strongly advocating a soft landing, we may see stocks do quite well on that. But if he pauses and says, well, we need more data, we're worried about energy prices. If it depends what kind of skip it is. So obviously his conference and the questions he gets asked to field are going to be vital to what goes on afterwards in the market. And I would keep a very close eye on bond markets through all of this because they will be the key. So big tech stocks have outperformed recently. They're doing very well, but I would say they're defying higher rates at the moment. If you look at this chart on the bottom right here, you can see that usually we get this divergence as US yields rise. We often see tech stocks fall. At the moment, we're seeing a rise in yields and we've got a rise in the tech stocks as well. So something could break here. So I think it's really important to keep a very close eye on this. If we look at the chart on the left here, the Tech 100 daily chart since January, this has been a very strong market indeed. And to be honest, it's dealt very well with an awful lot of the fear from people like myself suggesting there are risks out there. It's actually done very well, up 40% year to date. What does that tell me? The market is long. The market is deeply invested. AI has obviously helped, but higher interest rates, as you can see from the chart on the right, can impact tech stocks. And I think we need to be careful here because it's going to be vital what message Powell wants to send. Then on to the Bank of England. This is interesting because we saw rising wages yet again earlier in the week, which is going to keep inflation high. Although he seems to believe inflation is going to fall pretty rapidly and they could be nearing an end to hikes. The meeting is actually at 12 o'clock on Thursday, London time. The press conference at 12:30. I'll be very interested in what he has to say. He's got two issues here. Food inflation is beginning to ease. There's no two ways about that. But we've got a weak GDP number. We've got relatively weak UK indices. We've got rising oil prices, and we've got elevated wages. I mean, wages are all-time high, well, highs we've seen for 15, 20 years. So there's a real problem with this record wage growth. You can see here on the chart on the right here, bang back up to 80%, 8%. There's still some big wage deals being negotiated out there. And this is very concerning. And I don't see how inflation can really fall very far or very quickly with that still in place. So it shows you there's still a bit of a labor shortage, but we are starting to see unemployment starting to rise a little bit, which is good news, not for those losing their jobs, obviously, but for the Bank of England's point of view. It may start cooling off some of this inflation. But the idea that the Bank of England are done raising rates, I think, is just fanciful. They have still got a wage growth problem. They've still got a relatively strong inflation problem that they have not managed to get in front of. So this talk of, we're near the end, I think is rash. So sterling is sitting on some key support levels. We had this yield differential boost to sterling, as you can see on the chart here on the left-hand side of it. But this has really moved. Now, it was quite interesting that even with stronger wage data, sterling didn't manage to hold on to the gains. So the market is beginning to think that the Bank of England is going to be forced to hike rates through inflation, but it's beginning to impact the economy. And we saw that in the GDP numbers this morning. GDP fell again, and it's at a level now that is beginning to suggest that the recession is possibly looming. And that means hiking is going to be very difficult. Do we have that whiff of stagflation also in the UK economy? I think we do. So I have to say, though, that the UK 100 in the last few days has had a little bit of outperformance. I think falling sterling has helped. If you look at the fall in sterling on the left here and the rise in the FTSE 100 on the right, you can almost flip them over. So again, because it's an export-based stock index, then the FTSE 100 does better when sterling falls. But also, oil and energy companies have done well in the last few days, which are a major part of the FTSE 100, of course. So that is helping. But I don't think investors, the fact that everybody tells me that UK stocks are cheap, well, if they're cheap, why aren't people flooding in to buy them? There is a worrying concern of mine, a real concern of mine, that the UK is slightly uninvestable at the moment. People don't trust what the UK is trying to do at the moment. Since Brexit, we've kind of lost our identity, and I think that is being shown in the lack of foreign direct investment into the UK, and also asset managers being prepared to buy into the UK markets as such. And so this has been weighing a little bit on sterling as well. Bank of Japan, their meeting's on Friday. The decision is due at 4 o'clock in the morning, UK time. And the Governor Ueda's press conference, 7 o'clock. Sometimes that can be a little delayed. Again, I think the press conference is going to be the interesting bit of this. There are certainly implications for dollar yen and the yen crosses and the Nikkei 225. The issue here is that he made a very bold statement the other day saying that if wages do start to rise much further, they may be able to abandon their easing policy. However, that seems to be something for the end of the year or into next year. There's an awful lot of water to run under the bridge between now and then. And the yield differential between the US and Japan remains where it has been for a long time, which is very wide, which is why dollar yen has rallied. So after these comments from Ueda, and if he says anything again about this in the press conference on Friday, the problem is, whilst we've had this dip from the highs in dollar yen, as you can see here on the chart, from this 147.86 level, Ueda talked the yen higher by suggesting that the easing policy could end, but we're back up. The market won't believe him unless they actually do something. And there's a danger now that if they do nothing at this meeting, then traders will realize that there's nothing coming with policy until the next meeting, which is about 6 weeks away. Now, with the yield differentials with the US, this could drive dollar yen back up, maybe even to 150, who knows? But then do we get into the territory where the Bank of Japan has to intervene? Because if they're not going to change things with policy and they want to change the value of the yen, they're going to have to intervene. So it is a risk. We have seen some verbal intervention from the authorities. This could pick up. If it does pick up, I would beware, because when it does, it often means they're closer to doing something. I think they've tried to talk the yen higher. I don't think it's working. I think, if the Fed makes a hawkish skip, if you like, and yields in the US stay high, dollar yen is going to struggle to go down unless the Bank of Japan and the MOF do something about it. So I think they are closer to intervention. I don't think it's there just yet. I think they want to see how fast the market moves through these meetings. And I think once we get the central bank meetings out of the way next week, I think that could open, if they're not going to do anything policy and the yields stay high in the US, they may be forced to do something. So I think there's a lot of volatility around the yen over the next few weeks. I'll be very careful trading this. Just keep your stop losses in case they come in and do something. But realistically, unless they're prepared to change policy, dollar yen is probably not going to come off very far. And it is led by US yields at the moment. So if 10-year yields and 2-year yields in the US keep going up, that's going to widen the gap between the differentials of the two interest rates. And therefore, the natural thing is to buy dollars and sell yen. That pays you money to hold those positions. So that's what's going on. So the meeting's an important one. The statement's important. The press conference, very important. See what traders make of it. But I don't see a policy change at this meeting. So it's going to be an interesting one. That's for sure. Well, that's me. I hope you enjoy the next few weeks trading. I think it's going to be really interesting. And hopefully you'll be back for more of this in a month's time.